Hi there. Welcome to the Brunsdon Asset Management Market Update. I'm pleased to have with me this morning Jonathan Webster-Smith from Macdonald, who is the investment manager for the IFSR Brunsdon Cautious and IFSR Brunsdon Adventurous funds. Good morning, Jonathan.
Nice to be here, Brian.
Thank you. It's been a busy time in investment markets, and we have some frequently asked questions from clients. I wonder if I could run through two or three of the most popular ones.
Of course.
The one which is mainly on people's mind at the moment is to do with, of course, the virus. How do you see that affecting markets going forward?
I think one of the things we saw, if we go back sort of to last summer, where we had inverted yield curves, and people were starting to talk about is the US and potentially the global economy going into recession, i.e. where we're going to get some negative growth numbers out. Those fears were dispelled. We had some positive actions from the Federal Reserve and the UK central banks. But what we're seeing this year, obviously, the positive tailwinds that we've got is being hit by a sort of left field event in the coronavirus, in the sense that we've seen 25,000 flights stopped in China, travelling around China. Clearly that is going to have an impact on the Chinese GDP, and we're not yet sure on the knock-on effect to the global GDP. So we're already in a low growth environment world. So again, we're just slightly cautious. Whilst of course the central banks are very accommodative at the moment, we just need to watch and monitor, because obviously when growth is so low, shocks like this can have a bigger effect than perhaps people think. So at the moment things look contained, and it's not past the peak of the virus, but at the moment from a GDP point of view, things, the consumer and the manufacturing side are looking okay.
Is it mainly the Chinese market which is affected here?
I mean, obviously the outbreak started in China. It's clearly we would expect, the biggest impact in the Chinese. So we're currently thinking around 1 or 2 percentage points off Q1 GDP for China. What we shouldn't forget, of course, is how interlinked the world is. So any slowdown in China we would expect to have a knock-on impact onto the emerging markets. And then we need to remember that Europe exports 50% of goods to the emerging markets. So I think the biggest immediate impact will be China, but it clearly will have a knock-on impact that we need to analyse as well.
Thinking about companies and how they're performing, last year was a great year for equities. How do you see this mapping out over the next 1, 2, 3 years?
Well, if only every year was like last year, where you had lower risk assets producing sort of double-digit returns, and the more adventurous side producing over around 20%. So certainly it's a phenomenal year. One note of caution, I would say, is what we saw last year was very much driven by price, the price of shares going up, and the underlying earnings from those companies didn't necessarily keep pace with the growth in the prices that we saw. So one note of caution is, of course, that unless we see those corporate earnings start to come through, I probably wouldn't say to you that this year is in line for double-digit growth, particularly at the lower risk end. So that's one note of caution. Clearly, if we get superb corporate earnings coming through, it is entirely possible. But what I think is we need a pause while corporate earnings catch up. That's certainly sort of the base case. The second positive, of course, we have pretty much synchronized global accommodative central banks, and that's in making sure the liquidity is in the markets and where it needs to be. So that again is a base support for markets, which should be supportive for risk assets.
I suppose one of the big areas with the geopolitical scene is, of course, the US elections, which are coming up soon. What are your thoughts on that?
Well, I mean, geopolitics clearly is around in markets all of the time. Clearly, the trade wars having an impact on ultimately fueling demand for treasuries and the US dollar. Clearly, that's starting to see that unwind. The next, as you say, event in terms of the geopolitical calendar, or certainly one of major note, will be the US election. And actually, there's a very strong correlation between the performance of the S&P 500, so the main US market, and Donald Trump and Donald Trump actions. Effectively, when people think he's about to get re-elected, that's generally a fairly positive interpretation for the market. If we get the sort of Bernie Sanders type character in, clearly he may not be quite so market friendly. A bit like a sort of Tory government here would be perceived to be more market friendly than potentially a Labour government. I think so that's clearly something that we need to watch. And of course, it won't be on election day. We have to watch it. It will be sort of in the few months running up to it. So again, one of the things we need to look at is our exposure to the US. in the run up to that. But there are always geopolitical events that we need to factor in, and what we try to do is track through how it plays out onto different sectors and therefore into different parts of the globe as well.
Okay. Any predictions for the year?
Hey, I'm fairly positive. I think we've got a backdrop of accommodative central banks. The expectations that we have is that corporate earnings will be positive. Indeed, they've started fairly well in the technology and the banking sector in the US. How it ultimately plays out with the US election being in November is clearly quite a difficult one. But at the moment, our probability is that Trump will get back in, and therefore we would be positive towards risk assets.
Okay, well, thank you, Jonathan, and thank you for listening. That was a quick market overview. We hope it's been of interest and informative to you. As ever, if you have any questions or queries, please be in touch with us, and see you again next time. Thank you.